Do you know that some fund managers use a trick to make their portfolios look more beautiful and profitable than they really are? It's called window dressing, and it's a deceptive practice that can affect your investment choices. In this video, I explain what window dressing is, how it works, why it is done, and what are the risks involved. Stay with me until the end and you will discover the truth that hides behind the windows of finance. Window dressing, literally, window dressing, is a metaphor taken from the world of commerce. It refers to the art of decorating and embellishing the windows of shops to attract attention and curiosity of potential customers. In finance, window dressing is the practice of artificially modifying balance sheet positions or investment portfolios before the end of a certain accounting period, such as the end of a quarter or a year. The purpose is to create a positive perception of the value of an asset or the state of the company that does not correspond to reality. How do you do window dressing? There are different ways, but the most common one is to sell securities that have had a negative performance and buy those that have had a positive performance in the period considered. In this way, the fund manager can show his clients or potential investors a portfolio composed of winning securities, hiding the losses incurred. This operation is usually carried out on the last day of the quarter or a year when the markets are more liquid and prices more volatile. Why do you do window dressing? The main reason is to attract new capital or to maintain existing ones. Fund managers are in fact remunerated based on the value of the assets under management and the fees they charge to their clients. The higher the value of the fund, the higher the fees. Moreover, fund managers are often compared with benchmarks or reference indices that measure their performance against the market. If the fund exceeds the benchmark, the manager can boast of having beaten the market and generated added value for his clients. If instead the fund underperforms the benchmark, the manager may be questioned or even replaced. What are the risks of window dressing? Window dressing is a deceptive practice that can harm investors in several ways. First of all, window dressing distorts the real composition and performance of the portfolio, making it difficult to evaluate the quality and consistency of the investment strategy adopted by the manager. Secondly, window dressing increases transaction costs and taxes for investors, as it involves a higher frequency of buying and selling securities. Thirdly, window dressing can expose investors to higher market risks, as the securities purchased to embellish the portfolio may not be suitable for the risk profile and objectives of investors. How can you avoid falling into the trap of window dressing? There are some precautions that investors can take to protect themselves from this deceptive practice. Here are some tips. Do not rely only on short-term performance, but evaluate the consistency and quality of returns in the long term. A fund that has exceptional performance in a quarter may have obtained it thanks to window dressing and not to a real management ability. Check the composition of the portfolio and verify if there have been significant changes on the last day of the quarter or year. If you notice any anomalies, such as the purchase of securities that are not in line with the strategy of the fund, or the sale of securities that have had a negative performance, it could be a sign of window dressing. Compare the portfolio of the fund with its benchmark or reference index and check if there are excessive divergences. If the fund has a very different composition from its benchmark, it could be more exposed to specific risks or missed opportunities. Inform yourself about the policy and transparency of the fund manager and check if there are any rules or ethical codes that regulate his activity. If the manager is subject to internal or external controls, rules of rotation of securities, or limitations in the use of derivative instruments, he could be less inclined to practice window dressing. These are just some of the ways to recognize and prevent window dressing, a deceptive practice that can affect your investment choices. I hope this video was useful and made you understand better what window dressing is and how it works. If you liked the video, leave a like, subscribe to the channel, and activate the bell to not miss the next videos. If you have any comments or questions, write them below and I will try to answer you as soon as possible. Thank you for following me and see you next time.